In September 2024, the Federal Reserve cut interest rates for the first time in over 4 years. A 50 basis point cut. Big move. Headlines everywhere said relief was coming. Mortgage rates were going to drop. Credit cards would get cheaper. The economy was finally loosening up. And then mortgage rates went up. Not by a little. By January 2025, the average 30-year fixed mortgage had climbed back above 7%. Nearly a full point higher than where it sat the week of the cut. The Fed kept cutting, 3 times by the end of 2024, 100 basis points total. And still, mortgage rates didn't follow. Credit card rates dropped about 1 percentage point against nearly 2 points of cuts. Auto loans barely budged at all. This isn't a glitch. This is the system working exactly as it was designed. And understanding why is one of the most important things you can learn about how money actually moves through an economy. Because the lag between when a policy changes and when you feel it isn't random, it's architectural. And that architecture has consequences most people don't see coming until they've already arrived. Here's the core problem. When people hear the Fed cut rates, they imagine a single lever connected directly to every interest rate in the economy. Pull it down, and borrowing costs fall. Push it up, and they rise. That mental model is clean, intuitive, and almost entirely wrong. What the Fed actually controls is one very specific rate, the federal funds rate. That's the overnight lending rate between banks. It's the shortest-term interest rate in the entire system. Think of it as the base clock speed of the financial processor. It sets a tempo, but it doesn't directly control what every other part of the system does in real time. Mortgage rates, for example, don't track the Fed funds rate. They track the 10-year Treasury yield. And the 10-year Treasury yield is driven by an entirely different set of forces. Inflation expectations, government borrowing needs, global demand for safe assets, investor sentiment about the future. When the Fed cut rates in late 2024, Treasury yields actually rose because markets interpreted the cuts as a sign that inflation might not be fully contained. The bond market was essentially saying, "We don't trust this yet." So there's your first layer of lag. The Fed moves, but the instruments that actually price most consumer debt don't respond to the Fed's move. They respond to what the market believes the Fed's move means for the next 5 to 10 years. That's not a bug. That's how a market-based financial system processes information. The short end of the rate curve and the long end operate on completely different logic. But that's only the beginning. Even when market rates do shift, the transmission into the real economy happens through a series of intermediaries, each with their own timing, incentives, and friction. Banks don't automatically pass rate changes to customers. They adjust lending standards, recalculate risk premiums, and decide when and how much to move based on their own balance sheets and competitive pressures. A meta-analysis published by the International Journal of Central Banking found that in developed economies, the full transmission of a rate change to prices takes anywhere from 25 to 50 months. The average across dozens of studies, 29 months, nearly 2.5 years. That number should stop you cold. It means that when the Fed started hiking rates in March 2022, the full price effects of those hikes may not fully materialize until 2026 or 2027. Research from CEPR analyzing disaggregated price data supports exactly this. The 2022 to 2023 rate hikes, viewed as a sequence of monetary contractions, would take until roughly 2026 to be fully reflected in the data. You're not living in the economy that current policy is building. You're living in the economy that policy from 2 or 3 years ago is still shaping. And the economy you'll inhabit 2 years from now is being determined by decisions happening right now that you won't feel for a very long time. This is what makes the lag so dangerous. Not because it exists, engineers deal with latency all the time, but because most people don't account for it. They assume cause and effect are nearly simultaneous. Rate cut today, cheaper mortgage tomorrow. Rate hike today, pain kicks in next quarter. The actual timeline is so much longer than intuition suggests that people consistently misjudge where they are in the cycle. And it gets worse. The lag isn't uniform. Different parts of the economy absorb rate changes at wildly different speeds. Financial markets react within hours. Stock prices, bond yields, and currency values reprice almost instantly. But consumer spending on durables and luxuries takes weeks to shift. Business investment adjusts over months, employment changes over quarters. And the full effect on consumer prices? Years. Recent research using high-frequency bank transaction data out of Spain found something fascinating. Consumption and investment, variables everyone assumed were slow-moving, actually respond within weeks of a policy change. But employment and consumer prices remain stubbornly slow, peaking at much longer lags. The economy doesn't respond to rate changes like a volume knob being turned. It responds like a cascade, fast at the surface, progressively slower as you move deeper into the structure. This creates a timing trap. The effects that are most visible, financial markets, headlines, asset prices, react first and loudest. So people anchor their expectations to those early signals. When the Fed cuts and stocks rally, it feels like the cut is working. When the Fed hikes and markets sell off, it feels like pain has arrived. But the deeper structural effects, the ones that actually determine whether businesses hire, whether construction resumes, whether inflation genuinely cools, are still months or years away from materializing. The commercial real estate sector is a textbook example. After the Fed began hiking in 2022, CRE didn't immediately seize up. Transaction volumes declined gradually. Lending standards tightened over quarters, not days. By 2023 and 2024, the industry had adopted a mantra: stay alive until 25. The assumption was that rate cuts would arrive and unlock frozen capital. But when cuts did come, long-term Treasury yields didn't cooperate. Mortgage-backed security spreads stayed elevated, roughly double their pre-2022 averages. Investment sales volume in the second quarter of 2025 hit $115 billion, less than half the $260 billion the sector was moving in the low-rate peak. The pain from the hikes arrived on a delay, and the relief from the cuts is arriving on a delay too. This is the mechanism that most financial education skips entirely. It's not just that there's a lag, it's that the lag creates a compounding mismatch between perception and reality. People feel like they're responding to current conditions, but they're actually responding to conditions that were set in motion 1 to 3 years ago. And their current decisions, borrowing, spending, investing, are creating conditions that won't fully manifest for another 1 to 3 years. The practical architecture of this matters more than the theory. If you have a variable rate debt product, a credit card, a HELOC, an adjustable rate mortgage, you're on the fast clock. You feel rate changes within 1 to 2 billing cycles. But if your income depends on business conditions, employment trends, or housing market activity, you're on the slow clock. And the mismatch between fast debt repricing and slow income adjustment is where most financial stress actually originates. Your costs can shift in weeks. Your earning power shifts in quarters or years. Designing around this means thinking in layers. Your short-term financial exposure, what you owe on variable rate products, lives on a different timeline than your medium-term exposure, like fixed-rate mortgages or business loan terms coming up for renewal. And both of those live on a different timeline than your long-term exposure. Career prospects, property values, industry health. Most people treat these as one thing, responding to one rate environment. But they're 3 different systems, each operating on its own clock, each lagged differently from the policy inputs that drive them. The people who navigate rate cycles well aren't the ones who predict where rates are going. They're the ones who understand that the effects of where rates have already been are still propagating through the system, and they position accordingly. They don't react to the headline. They think about what the headline means 18 months from now. This is also why rate policy is so hard to get right from the central bank's perspective. An IMF study found that during early 2022, monetary policy transmission was roughly 25% weaker than historical norms. For every 3 rate hikes the Fed delivered, only the equivalent of about 2 were actually reaching the economy with the expected force. The system was absorbing the shocks differently than models predicted, partly because of pandemic-era distortions, partly because the economy's structure had shifted. The Fed was effectively flying with instruments that showed a lagged, incomplete picture of what their actions were actually doing. And that's the uncomfortable truth at the center of all of this. The lag isn't just a personal finance problem, it's a systemic design constraint. Central banks are steering an economy where the feedback loop between action and outcome takes 2 to 3 years to close. Every decision they make today is a bet on where they think the economy will be in a future they can't precisely measure. And every decision you make today exists inside that same fog. If this kind of systems-level breakdown is how you prefer to understand money, subscribe to 8-Bit Economics. Every week, we strip complex financial mechanisms down to their core architecture. No hype, no predictions, just the underlying code of how these systems actually work. Hit subscribe, leave a like if this shifted your thinking, and drop a comment with your take on where you think the lag is hitting hardest right now. By the time everyone sees it coming, the smart play is already over. There's one final thing worth sitting with. Milton Friedman described monetary policy lags 65 years ago. The effects come only after a considerable delay over a long period, and the delay itself is variable. 6 decades of research later, that description holds. The average lag hasn't shortened. If anything, greater financial complexity has made it longer in developed economies. The system hasn't evolved past this constraint. It's baked into the architecture. Which means every time you hear that rates just changed, the most important question isn't what happens next. It's what already happened 2 years ago that's about to arrive.